Okay. Okay, everyone. Good evening. Good evening. Thank you for joining. This is our first webinar for 2025 titled 2025 Market Outlook. But as always, we'll be discussing three things we do well: financial psychology, financial planning, and investment management. So this evening, we will have Dr. Brad touching on the psychology of communication in estate planning. Nick Murata will discuss updates on the Secure Act 2.0, and we will have Bora close off with the market outlook. But before we get started, let's just go over our disclosure. The information contained herein is intended to be used for educational purposes only and is not exhaustive. Diversification and/or any strategies that may be discussed is not guaranteed against investment losses, but are intended to help manage risk and return. If applicable, historical discussions and/or opinions are not predictive of future events. The content is presented in good faith and has been drawn from sources believed to be reliable. The content is not intended to be legal, tax, or financial advice. Please consult a legal, tax, or financial professional for information specific to your individual situation. So with that out of the way, we can get to the fun part with Dr. Brad. Oops, here we go. Who will start on the psychology of communication in estate planning. So Dr. Brad, please take it away.
Thank you. And congratulations to you, Gio, for attaining the highest designation in the field of financial planning, your CFP. Super excited to celebrate that milestone with you.
Thank you. Thank you.
So I wanted to kick off 2025 with a discussion around estate planning. Now, a lot of our clients already have estate plans. And essentially, estate plans really help us come up with a plan for what we want to see happen in terms of our assets, who gets what. In the case of death or incapacitation, it's more than just assets. It's all of our wishes related to our medical directives, et cetera. And most of our clients have these in place. And if you don't have them in place, I would encourage you to talk to your advisor in your next meeting or just reach out to them, because it's relatively important for most people. Now, the state you're in already has an estate plan for you. They will manage your estate just fine, but it might not be the way you want it managed. And so to have a customized one is really important in turn, especially if you have dependents, especially if you have specific healthcare directives that you'd like to see respected. But there's another element to estate planning outside of the conversation with your advisor, with your partner, your spouse around what you'd like to see happen. And I think it's one of the reasons why people avoid doing it. So 60% of Americans lack a will and estate plan. Some have a will, but the majority don't. 41% of young adults have never discussed estate planning, and half, and this is what we're going to be talking about today, something for you to consider. There are actually pros and cons to whether you talk to your adult children about your estate plan, what you'd like to see happen. I'm going to talk about some of the risks. And for some people, they don't want to talk about every aspect of the plan, but it might be important to talk about some aspects of the plan. And it really comes down to thinking about, what do you want to see happen when you're no longer around, in terms of, quite often, the relationships that your descendants have between and amongst themselves. So most adults don't know what their parents' estate plan is. So there's some pitfalls to a lack of communication around that. And a big part of that is not being aware of the estate intentions. Perhaps you've seen movies. I was trying to think of which movies they were, but it's sort of this classic scenario where the head of a family passes away. The lawyer comes out to read the will. It's a very dramatic situation. The descendants are in the room, and then it's almost like a bomb being dropped in the room, and there's upset and people are stomping out. People didn't think they got what they got. or people are upset because they feel like there was undue influence by another family member towards the deceased. So a lot of misunderstandings can arise. And that's the dramatic example, but there are many less dramatic examples that come into play all the time. For example, let's say that a couple has a son and a daughter, and they want to distribute their estate equally to both. And let's say that they have a certain property that's worth, for the case of argument, $500,000. And then they also have investable assets that are worth $500,000. And in their minds, they might just think, well, I'll give one to one kid and one to the other, sort of a flip of the coin. And from the mathematical side, that sounds like it's equal. There shouldn't be a problem. There shouldn't be an issue. But without explaining to kids how you came up with this idea, perhaps it's somebody enjoyed skiing when someone didn't, whatever it is, they're going to be left to make up stories. And I've seen this play out where even when things are totally fair when it comes to the actual financial numbers and a calculator, there can be emotional attachment to a particular piece of property. And then the child's left thinking things like, and quite often these are like unresolved issues in childhood. Oh, mom and dad liked you best. Why'd they leave you that? So they're left to make up their own stories for why this happened. And sometimes those stories are okay, but sometimes they reflect wounds and unfinished business, if that makes sense. But I will say this too, it can be challenging to talk about estate planning. Sometimes kids don't really want to hear it. It can be an uncomfortable topic to think about someone's demise and the family. And so that can make it hard to talk about. But there's a couple examples, and these are real examples where that lack of disclosure has led to problems. And I'm intimately involved in these situations. So one situation was a grandparent's estate. They had it all lined up where they wanted things to go, but they didn't discuss it with their kids and their in-laws, their kids' spouses, and their 26 grandchildren, roughly. I think it was 23 or 26 grandchildren. And when the will came about, the grandchildren were surprised by some of the contents, and it led to disputes. And there were concerns because one of the children in that family system was left as the executor of the estate. And, you know, from my perspective, because I had been involved before they had passed away, it seemed like there wasn't any undue influence from my perspective, and it seemed like it was fair in terms of how things were being distributed. But people were left to make up stories. And it turns out that this one sibling, the other siblings had already had feelings towards this sibling. And since the grandparents didn't talk about what they wanted and why they wanted it to happen, the family was left thinking that the sibling who was the executor of the will had undue influence. And, you know, mom and dad actually wanted this, but you must have told them that. So essentially, it just created a bunch of unnecessary family strife that has been going on for over a decade now, where people are trying to make up the stories for why somebody did what they did. Unfortunately, that's rather common too. But it can get even worse. For example, another example, we'll call this client Susan. She updated her estate plan, but didn't inform the kids. So she had previously had an estate plan, and they had been privy to that. But she updated it and then failed to talk about it with her kids. This led to legal battles because they were concerned about one child, again, having undue influence. That's not what she intended. Perhaps she was having some cognitive decline. So there was some problems that resulted from that secrecy. And by the way, there's a lot of good reasons too to have some secrecy around it. Sometimes, you know, quite frankly, we don't really want to deal with the drama. I just think and so we actually would rather have our kids deal with it, which is an interesting choice and one that I can frankly respect. But just being, I think, aware and thinking through the potential downside to those types of surprises can be really, really important. So in terms of expressing intentions and why that's important, it can really help clarify why you're doing what you're doing, why it matters, so that people can avoid making a story up. They might not be happy with what you're doing, but it will protect them from making up a story, which could be even worse. And that silence around what you're doing and why you're doing it can lead to misunderstandings, and it can then lead to conflicts. And so the idea is to try to avoid misunderstandings, to try to avoid errors in how things are playing out, and to reduce conflict in your family system when you're no longer around. So, how do we tackle this? What are some good ideas on avoiding some of those potential downsides to not communicating your intentions? Having some open discussions, and start early. And it's okay to revise things as you go, but just a general understanding. You might not want to tell your kids exactly what they're getting or how much. So there, and maybe it's age appropriate or age inappropriate to give too much information. And this is something that, a conversation that probably gets revisited over time. And involving the beneficiaries in those conversations outside of just you and your partner, your spouse, your immediate family, and having those conversations. And then perhaps even a family meeting. And by the way, if you would like one of us as your advisors to help facilitate that type of meeting, we're happy to do it. We're happy to be a part of that. Any one of us, or we can, any advisor can bring me on board for that type of meeting. But that's a service that we do provide to clients, and let us know if that's something you'd like, to help you structure that meeting, to help you think about how you want to present this information, and to be there in case we run into any hiccups. So having that type of family meeting can be extremely valuable. There's opportunities to build in transparency, to build in trust. It really is helpful to come in with a prepared agenda, which any one of us can help you do, where we can really talk about, like, what's the purpose of this and what are we trying to avoid? What information do we really want to address? And if conflicts do ensue, we can make a referral to a mediator or a family therapist, although that's a very rare circumstance, but it does and can happen. The key, though, for us as individuals, I have found in my work that some people resist the entire concept of putting together an estate plan. And sometimes it's a partner who doesn't want to have an argument with their spouse. And by the way, that's fairly common in blended families, for example, because things get a lot more complicated, of course. And sometimes it's just we don't even want to think about the worst case scenario. We don't want to think about, what could possibly happen to us that could go wrong. So could be some discomfort there. But just to understand that this is something that we as advisors, we have these conversations frequently, and we can help you manage some of that too. And we can help mediate those conversations. And ultimately, it comes down to you. You're our client. We just want you to become aware of some of the potential downside to not having those conversations. And because a lot of parents and grandparents, we will have a vision of how we would like our children to interact with each other and how we want our family system to interact when we're no longer there. Some people have a really clear vision of that, some people less clear. And the degree to which that's really important to you, that you want your children, for example, to have a good close friendship after you're no longer there, your grandchildren, et cetera. The degree to which that is important to you, I think that is a good measure to why it might be important for you, or even more important for you, to have these open discussions around estate planning and communicating what it is you want. So communication does a few things. The legal documents, the estate plan, puts into place your intentions so that it's crystal clear in writing, so nobody's left to wonder on the exact distribution of funds, or who's going to be making decisions in the event that you're incapacitated, or who's going to be taking care of your children in financially, and also with regard to custody, just to lay those out. But the deeper conversations around the why, and that's something that those estate planning documents don't really mention. The why. What is the thinking? What is the motivation? What is your vision for why you're wanting these things to happen? And ultimately, with that communication, it really does significantly improve the chances that there'll be harmony when you're not there amongst your kids, your grandkids, and the people you really love. With that, I will kick it over to my partner, Nick.
Thanks, Brad. Appreciate that. A lot of good information. And last thing anybody wants is an estate plan that divides a family as you give a legacy and inheritance. it should be beneficial to the ones that are receiving it. And communication, I think, plays a strong role in making sure that happens. So that's a lot of good information, a lot of emotion tied in with giving an inheritance, receiving an inheritance. There can be a lot of emotion there, and so talking things out is sometimes a really good thing. So I have probably the most boring topic of the night, but I will try to make it as interesting as possible. I thought it'd be good for us to revisit the Secure Act 2.0. The original Secure Act was in 2019. Very broad legislation, a lot of information, a lot of different changes. It was supposed to be the Setting Every Community Up for Retirement Act, and the objective was to encourage more workers to save for retirement. But there's a lot of things that are from inheriting IRAs to 529s to retirement plans. And there's been, like most IRS legislation that comes out, a lot of confusion along the way. And they've had to push back some things they wanted to roll out, and there's kind of been a multi-year rollout. So there are some things new this year that I thought we should just kind of revisit. All right, there we go. So if you are over the age of 50 and this has been in place, you can make a catch-up contribution. You can make a catch-up to your IRA, you can make a catch-up to your simple IRA, you can make a catch-up to your 401k. But brand new this year is the super catch-up, which is if your age is between 60 and 63, you can make an additional contribution to your 401k or your simple IRA. And just to kind of go through the example here, in 2025, as an employee under 50, you can contribute $23,500 to a 401k. If you're over the age of 50, you can contribute $7,500. So that's a total of $31,000. But if you are in the super catch-up age of 60 to 63, you can actually contribute up to 10,000 or 150% of over 50, which is this number, which equals 11,250. So you could actually get in 34,750 into a 401k. And if you turn 60 this year, even if it's December 31st, you can do the super catch up. And you have to stop if you are over the age of 63. So if you turn 64 this year, for example, you cannot do the catch up. And that's the way the rule is written. With a simple IRA, you can do a $3,500 catch up and then an extra 150% of that if you're between 60 and 63. So one of the caveats of this, and that was in the legislation a while ago, but they pushed back, and it seems that it will go into effect next year, is that if you're doing a catch-up over the age of 50 and you are an income earner of over 145,000, you won't be able to do the catch-up into the pre-tax portion of your 401k. You'll have to do in the after-tax, or what we call the Roth portion of the 401k. Which is a little counterintuitive because the higher you earn, the more you may need a tax deduction. But this is, I think, the way of the IRS's way of, making you pay some taxes on the money and still getting it in the retirement account. So this was supposed to be initiated this year. They pushed it back to next year. And there's still some confusion because some 401k providers don't have the monitors or the systems in place to make sure that this is what actually takes place, and don't even have a Roth portion of the 401k. So we're actually expecting additional guidance. Lots of times this happens where some legislation is put into law, and then there has to be some clarity after the fact. So we do expect some additional guidance by June in regards to the 2026 catch-up. That's for next year. And this is just a reminder, an inherited IRA. This actually took place with the first Secure Act. So if you inherited an IRA after 2020, you basically had subject to the 10-year rule, which means you had to distribute that IRA within 10 years and take an RMD for each of those years. The IRA would have to be completely emptied if it's a traditional IRA by the 10-year mark. Before that, we used to have a stretch IRA, which was based on your life expectancy if you inherited the IRA. And there are still few exceptions to that rule. If you inherit an IRA and you're a surviving spouse, you can treat it as your own, and it will be according to your life expectancy. If you're a child of a decedent, under the age of 21, that also can be a stretch IRA. If you are a beneficiary who is not more than 10 years younger than the decedent, that also can be a stretch IRA, or if you're disabled or chronically ill. Now, if you have an inherited IRA and you haven't taken out, and you inherited after 2020 and you haven't taken any funds out, the IRS is basically kind of granted relief if you haven't done that. So if you didn't take anything out between 2020 and 2024, there should have been a 25% penalty, but you've been granted reliefs. And this year, supposedly, and I feel like they've said this before, but this year, there's not supposed to be any relief. So if you haven't done it in the past and you don't do it this year, you likely will get hit with a penalty. Any new retirement plans that started after the end of 2022 has to have an auto enrollment feature. So if you start a new job or if you are a business owner and start a new 401k, this feature has to be in that 401k where there will be an auto enrollment for the employee of at least 3%, but not more than 10%. And there will be a gradual increase of every year. It needs to be increased by 1% until it reaches 10%, but not more than 15%. Of course, employees can opt out, but it is auto enrollment, and auto enrollment has been shown to increase participation. Maybe people forget about it. Maybe people don't want to make the change. I think it's good to save for your retirement. So I don't mind that there's an auto enrollment, but just be mindful that there is an auto enrollment feature in new 401k plans. And this last thing is just a reminder. The RMD schedule is graduated. This top part is how the IRS writes it, which is generally always confusing. So I just copied and pasted this little chart here. If were born between the ages of 1951 and 1959, either you are already on your RMD, required minimum distribution age, or when you hit 73, you will have to start taking your first distribution from an IRA. If you are born in 1960 or later, that would be age 75, where you'll have to start taking money from an IRA account. And so that's just a little housekeeping, couple reminders there, nothing too wild. If you have any questions about any of the stuff that I presented, feel free to reach out to your advisor and they can help you out. Our financial planning software automatically models in based on age, what your appropriate distribution and distribution age is, but we can help you out with those things. So I will pass it over to Bora and he will talk about the market.
Greetings. Good evening, everyone. I want to start this evening with Fed's decision to keep rates unchanged. This came fresh today and is relevant to our 2025 outlook. It was a move that was widely anticipated given solid and stable economic growth, low unemployment, and an inflation rate on its path down to Fed's target of 2%. Fed's commentary is in line with our view that the US economy is in no need for help from the makers of the monetary policy. On the other side of the coin, Fed's statements acknowledge risks that lie ahead as uncertainties remain in immigration, trade, deregulation, and fiscal policies. Our read from Fed's statement is the continuation of macro policy uncertainty. Almost everything I will mention in this presentation is subject to this particular risk we have. High valuations and concentration of gains that we saw across 2024 from a handful of stocks remaining major headwinds for the stock market, which reinforces our view is the importance of having a well-diversified portfolio while looking for risk-adjusted returns. Going back to 2024, we closed on a solid footing. Thank you, Nick, again. 2.7% GDP growth. These are still estimates, but that's what we're confident with somewhere there. 2.9% inflation and 4.1% unemployment rate for 2024. We see very similar trends this year. Economy may slow down a bit in 2025, down to 2.5% range. Inflation pressures will likely remain subdued, similar to 2024, and a slightly more elevated unemployment rate of 4.3%. These are subject to major macro policy changes, such as tariffs and immigration policies, both of which are inflationary, but also Trump government's pro-growth policies, such as deregulation, lower taxes, and energy production, may also impact growth and inflation. To check on our commentary, we're going to start with our economic timing model, borrowed by NDR, borrowed from NDR and Davis Research, which all of our research comes from the Davis Research. This is a current coincident economic growth, shows moderate growth. Please look at the right end of the chart, orange line, higher the better. We expect this moderate growth to continue in 2025. Next chart, please, Nick. And again, if we look at the other side of the coin, our global recession probability model is at the lower end of the bracket. I forgot to mention global economic growth is expected to be 3.1% in 2025. These are IMF expected numbers. Similarly, orange line at the right end of the chart, low reading indicates lower chance for global recession. We don't expect recessionary pressures for US or globally this year. Next chart, please, Nick. We are in a debt-driven economy. A credit conditions index is probably the most important data point. And if you look at the orange line, higher the better for credit availability, which supports our low recession probability forecast for 2025. Next, please. So one way we check our work on our inflation work is the Global Supply Chain Index, which has a 9-month lead on inflation. And you can see a pickup from the beginning of 2024 towards the bottom end of the chart, which doesn't surprise us to see some elevated inflation pressures this year. But still, if you look at historical records, those are still low. So we don't see we still see subdued overall inflation expectations in 2025. Next chart, please. This chart looks at the economy and where it is as far as the output gap. It shows that, again, kind of coincides with the global supply chain index, slightly higher pressure index, partly because the economy is on a strong footing. Next, please. All right, so if we add all this, all this in mind, and looking at today's Fed statement, we can project a slow Fed rate cut schedule for 2025. The colored lines here and the S&P 500 index trends during Fed easing cycles, fast, slow, and average of the two. The blue line here shows the average trend of the index during slow cycles, and which is the best of all scenarios. If we hear that Fed statement indicating slower easing cycle, we may hear some people not happy about it, but looking at 8 cases similar to this since Second World War, it's actually indicates a positive trend going out a year on S&P 500. So even though we may see disappointed market action, slow and steady for Fed easing actually works for S&P, historically speaking. Next, please. Thank you. So talking about headwinds, we talked about high valuations. The chart you're looking at shows price-earning ratio on its head, flipped 180 degrees. It looks at earnings and earnings yield. It looks at what an investor gets for the dollar invested. The lower end signals higher valuations. And you see at this, and the last time this happened back in 2007, 2000, 2001 and 2. We know the market action to the downside. So high valuations is definitely a strong headwind this year. Next, please. So the last chart in tonight's presentation is the common question we get is, can the market stretch its uptrend to a third year after a strong 2023 and 2024? And historically speaking, the answer is yes. The black line here is the mean average global stock prices. The green line right below is our current case. So there are still cases, obviously, that lasted shorter, but also cases that lasted longer. But the average, historical averages tells us the current bull market is not necessarily aging, another reason to stay out because it's in its third year. But more impactful headwinds are, as mentioned before, high valuations and policy uncertainty. And that's all, folks. Thank you so much. And sorry about the tech problems I had. Now we can open for questions.